Hi, everyone. I'm Diane Brady. I'm here with Bill Baldwin, who has been writing about taxes for 40 years. Is that right?
Yes, for Forbes, just for Forbes.
Just for Forbes. And you're also an enrolled agent, Bill. Why did you take that level of...
Well, it's supposedly I've memorized the Internal Revenue Code, but you know what? I got bored after page 10,300.
Well, but you're the perfect person to be talking about. You call them tax dodges.
That sounds wicked, doesn't it?
I think perhaps tax, avoidance, tricks, legal tricks. And we're starting with owning a house, which is something I personally currently do not do. And I've been debating whether I should, because the U.S. does have this sweet deal for taxpayers where basically we get to deduct our mortgage interest. So,
and you can't do that back in your native land of Canada.
Canada, no, we get it on the back end. We don't get the capital gains hit that you get here.
I see. So yes, it is special to be a homeowner in the United States. And by the way, deducting your mortgage interest isn't even the best deal. We have something else, and I think you also have it in Canada. We have something called imputed rent.
Is that, okay, so let me guess, that would be the amount I would have paid in rent?
Exactly. Yeah, that's the whole point. Listen, if let's just suppose that you buy a house for $400,000.
Mm-hmm.
And
Good
let's
luck.
just suppose
Good
you're
luck
rich.
with that.
Okay.
Yep.
Well, that would get you an apartment in New York City. Not even a studio. So let's just suppose you did, and let's suppose that you're rich, and you paid cash. All right. There's no mortgage to deduct. You still get a terrific tax advantage. Let me explain how that works. Suppose that you would have spent $3,000 a month on rent for that same place.
Yeah.
And let's just suppose that now that you're a happy homeowner, you're spending $1,500 a month on maintenance and $500 a month on property tax. So you're shelling out $2,000 a month, but you would have rented for $3,000 a month. This is what's happening to you, Diane. You're getting a $1,000 a month dividend from you, the landlord, to you, the home dweller. $1,000 a month dividend, that's $12,000 a year. Now, do you pay tax on that? The answer is no. So that's what you're really missing out. It is not even the mortgage interest. It's just the fact that you're not paying any tax on that $1,000 a month of essentially a dividend. It's like owning a real estate investment trust, but if you own one of those things, it's all taxed to here and gone. But when you own the house, there's no tax.
So I recall as a homeowner that I would take the mortgage interest deduction. At what point would I have calculated something around imputed rent? How does that, besides going to an accountant saying, don't forget, Bill Baldwin told me about this, how do you deduct that?
You don't deduct it. You just never report it.
Oh, okay.
So you're just getting this free rent. It's not income. Who, me? What income, you say to the IRS? That's the best thing about being a homeowner. And it's true whether or not you have a mortgage. Now, a mortgage is something separate. You can, if you do have a mortgage, you can deduct the interest. And as you were saying, that's not so easy to do in Canada. The next thing is that up to a point, and only up to a small point, you can deduct your property tax if you itemize your deductions. But the cap on that, it's a new cap, is $10,000 a year. You know, that doesn't go very far. And there are plenty of places in New York, definitely in New Jersey, where your property taxes could be easily more than $10,000 a year. You can only deduct 10. And by the way, that only applies if you itemize. And I don't itemize.
You don't itemize?
I take the standard deduction.
Because you end up in that place anyway?
Well, because I don't have a mortgage, and because if I did deduct my property tax, I could only deduct $10,000. So I just take the standard deduction, which, by the way, is a very big number. It's $27,700 for a couple this year. So you have to have a lot of mortgage, a lot of other deductions before that mortgage deduction really does anything for you. The big thing, though, is no matter where you are on the debt spectrum, you do or don't have a mortgage that is or isn't hard for you to pay back, you always get to ignore the fact that you're the landlord paying yourself rent by living there, and you don't pay income tax on that.
So I've known people who actually took a mortgage because they felt it was a tax advantageous would be the right term, that buying a house straight out with cash is actually not a good idea from a tax perspective. Is that true?
It's very, very untrue.
Okay.
Why? Why pay interest to a bank if you don't have to? Now, if you have to, if you're 30 years old and you're buying your first house, of course you're going to have a mortgage. When you get to be 50, you should have paid it off. You know why? The mortgage interest, even if it's deductible, is a big number.
Yeah.
It's 5%. It's worse, right?
Opportunity cost.
Right. And if you were to put money in the same bank, what would they pay you? They wouldn't pay you 5. They'd pay you 2 or 3, right? So it is not a good idea to be a debtor. You do it if you have to.
And you get the tax advantage. So tell me, you've got here, what happens in 2026?
Okay, the rules might change. Let's go back to a guy that we haven't entirely forgotten about, Trump. And he had this tax cut in 2017. Mm-hmm. And it basically said, we're going to kick up that standard deduction, the 27,000 and change I just talked about. We're going to kick that way up. And we're going to reduce some of the rates. And we're going to have some other goodies for these people and those people. We won't get into all of those. But basically, that law automatically sunsets on December 31st, 2025. Now, what's going to happen then? We don't know. So when you're buying a house now, you don't know what's going to happen at the back end. But it's likely that Congress will do some kind of an extension for parts of it and will refuse to extend the other parts. And if the Democrats and the Republicans can't agree on anything possible, then it just sunsets. And we go back in the year 2026 to what we had before 2017. And that's a different ball of wax, but one of the differences is, and it's an important difference, is that there wouldn't be a $10,000 cap on your state and local taxes. Mm-hmm. So that would be... It's good and it's bad if that happens. I don't think that'll happen. I think there will be some kind of a new tax law. But I could be wrong. There could be just a big fight in Washington, D.C. Nobody agrees on anything. If nothing is done, if nothing is signed by whoever's president in 2025, it sunsets. Well,
let's take the other side of the equation, because when you sell a house, you have to worry about capital gains taxes and such, right? In terms of talk about the benefits there. I mean, I don't know if that's what you're talking about with the $500,000 freebie. I immediately assumed, for a married couple, that's the amount that you don't have to pay tax on when you sell a house.
Right. So
Was I right?
You bought your imaginary house.
Right.
Good luck, $400,000. You sell it for $902,000. The only capital gain you have to declare is $2,000 because you get the first $500K home free. Now, there's some rules. I won't go into them. They're complicated rules. How long you have to have been there. The $500 is for a couple. If you're single, it's only $250. Mm-hmm. But that's a big deal. And, I thought of a way that you could turn this into a really nice, but you don't like me to call them Dodges, do you?
I mean, I prefer I think that I presume this exists because we want to incentivize people to buy homes because it makes them invested in society. So if I were in the government, you want to encourage home ownership. And this is one way to do it.
How virtuous you've made this whole thing seem. Let me make it less virtuous for you. Okay. You could have done the same thing if you were Congress and you said, we're not going to have the property tax deduction. We're not going to have the mortgage interest deduction. That imputed rent, we're going to tax that. And we don't like homeowners. Instead, they decided they like homeowners, but they could have done the same thing by doing nothing for homeowners and instead simply having a tax code that said, we're going to punish anybody who rents. We're going to have an extra tax on renters.
Punish the poor many times.
Punish the poor. Now, does that sound so virtuous? Anyway, that's the way it is. Homeowners are rewarded. Renters are effectively punished because they don't get these goodies. All right. So the $500,000. If you have a house that you bought for $400,000, you sell it for $900,000, no tax. That's a real benefit. And I thought of a way to magnify that. Mm-hmm. Should we call it unintended consequences?
Yes.
All right. Dodge. Let's just suppose, Diane, that you're really good with a hammer and a skill saw. Mm-hmm. And so you buy a house for $400,000.
Fix it up.
You fix it up. You put in $300,000 of sweat equity. And you put in $200,000 of You buy new windows and stuff. Okay, so your cost basis started out at 400.
Mm-hmm.
You put in 200 of windows and a new roof and so on. You have the receipts. Your basis is now 600. You also put in 300,000 of sweat equity. You're working. You're a contractor. You know how to build things,
Mm-hmm.
right? So now you've got a house that's worth 900,000. All right, and your cost basis, remember, was 600.
Mm-hmm.
400 for the house, 300 for the 200 for the windows
Mm-hmm.
and the roof. You've made a $300,000 profit, and basically what's happened is you've earned $300,000 by hammering.
Mm-hmm.
All right. Now, should that be taxed? And
I thought I could deduct it as costs.
no, we've already deducted.
Okay. So now,
all right. So what you've done here is you've been employed for 2 years
mm-hmm.
hammering, and you've been making $150,000 a year hammering, and you sell it for $900,000. But as long as you've lived in it for 2 whole years,
I don't get taxed.
you don't get, assuming you're married, you don't get taxed on the $300,000 of gain.
Mm-hmm.
And that's really like a salary, except instead of being paid like a bricklayer is paid,
Mm-hmm.
you're paid when you sell the house and you move across the street and fix that one up.
Mm-hmm.
So here's my idea. If you happen to be handy, if you happen to be a builder, you could just fix up houses. You could be a serial flipper.
And so is that the slow flipper strategy?
That's the slow flipper strategy. It has to be slow because you can't do it in 1 month. You have to be in it for 2 years.
Right, because you have to basically prove that, in essence, you're tantamount to earning a salary. This has been real sweat equity. You can't 10 hours or...
It doesn't matter how much time you put in. The point is that you have to have lived in it for 2 years in order to get the break. You can't get the break every month.
Okay.
So you have to space it out.
You can't. That makes sense. You don't want to encourage people to be flipping things too quickly.
No,
much like capital gains, right? If you hold a stock for longer, you get taxed on it.
This is better than This is better than stock. If you buy a stock for $400,000 and then you add another $200,000, that's $600,000. Then you sell it for $900,000. You got a $300,000 gain. There's no exclusion. You got to pay tax on the $300,000.
Okay, good. That sounds so. You've incentivized me to now buy and work on my house
and buy yourself a couple of hammers.
Excellent. Good advice. Thanks, Bill.
Thank you, Diane.